Hello everyone, welcome back to Accounting with Oscar. We are on the last question of the May-June 2025 Accounting Paper 2. So this will be the last video for a while. Yeah, probably for a couple of weeks. Right, so we're going to look into Rexford. We're going to prepare his purchases ledger control account as well as his income statement. So we've got quite a job ahead of us, and let's dive into it. So Rexford is a trader. All his sales and purchases are on credit. He does not keep a full set of accounting records, but has provided the following information. So we have his assets and liabilities at 1st of January 2024. This will be the opening balance, right? The balance brought down at the start of the year. So we have the fixtures and fittings sitting at 28,000 with an accumulated depreciation of 22,400. You have opening inventory of 6,000, trade receivables 21,750, prepaid insurance of 300, cash at bank 3,425, as well as the payables of 5,680. So that's all the opening balances at the start of the year. Now, we are also given the bank payments made during the year to 31st December 2024. We paid the payables 68,100 after deducting cash discounts of 380. Paid for rent and insurance 10,120. General expenses 4,730. Wages 6,400, and drawings of 12,200. So that's everything that went out of our bank. Now there are some additional information here, so let's read through it. The only amounts received during the year to 31st December 2024 were $103,200 from the trade receivables. Rexford applies a markup of 50%. I'm going to use a different color here. This is going to be very important later on. Depreciation is charged 20% per annum using the straight line method. Okay, straightforward. Inventory at 31st December 2024 was valued 400 more than the inventory at the start of the year. Okay, so you want to work that out real quick. Start of the year, our inventory was 6,000. So this is $400 more. So 6,000 plus 400, right? 6,004. The amount owed to the trade payables at 31st December 2024 was 25% more than the amount owed at the beginning of the year. So a lot of math to do here. At the start of the year, on 1st of January, it was 5,680. So 25% more. How much was that? 7,100, right? You do the math. So you should be getting 7,100. Alright, so I think that's all the information we are given here. So let's look at requirement A. Prepare Rexford's purchases ledger control at the end, for the year to 31st December 2024. Balance the account and bring down the balance at 1st of January 2025. Purchases ledger, what does that reflect? Purchases, it reflects the payables control, right? So payables are a liability. Liability increases on the credit side. So a debit will represent a reduction to liability. So got that out of the way, let's bring in the opening balances. So opening balances for the payables. Do you see it? Yeah, I'm gonna be like Dora the Explorer, do you see it? There you go, wonderful, okay. Good job, mi amigo. So 5,680. That's our opening balance on 1st of January 2024. So 5,680, right? Now, we're going to bring in all the information related to payables during the entire year. So that was the opening balance. I don't need that anymore. I will move on to the bank payments. So I paid 68,100 to my payables. That will reduce, right, the amount paid to the payables. So December 31st, bank, 68,100. Now that's one part of it. Don't forget your discount. It's very important. You have to take in the discounts as well. So discounts will reduce the payables. So this is a discount received from your supplier, 380. Okay, now what other information do we have? It's like fitting in a jigsaw puzzle. You're just gonna look for everything related to the payables. Yeah, closing balance, right? End of the year was 7,100. So there's another one, balance carried down, 7,001. So with that, I believe we can look for the figure for purchases. So obviously debit side is going to be larger. You have 75,580. So minus out the opening balance on the credit side. On December 31st, your balance carried down is going to be 69,900. So moving on to the next year, 2025, 1st of January, you're going to bring down 69,900. Oh, sorry, what am I doing? I'm sorry, this is not the balance carried down. This is the purchases figure. I'm sorry, it gets into me sometimes. My apologies. Okay, so that's the purchases figure. The balance should be 7,100. Okay, 7,001. Alright, so there we go. That's the purchases ledger control done. Easily score 4 marks there. I almost lost a mark. Okay, now with that done, let's look at the next part of the question. So the next part of the question, they want us to prepare Rexford's income statement for the year ended 31st December 2024. So to prepare the income statement, you need to know the pro forma in your head, right? You have to know what we are doing. So we start with revenue and we are going to deduct cost of sales to find our gross profit. That's the first part. So, do we have our revenue figure? Are there any information on revenue? No, in fact, we have no information about revenue at all, right? There's no figure relating to sales. And I mean, you could use the sales ledger control probably to find the sales figure. I don't know if you're gonna do that, but I have a simpler way of doing it, which is to use information 2. Right? We're gonna use the markup to calculate our revenue. So in order to calculate revenue using markup, we need to figure out what is our cost. What is our cost? What is the markup? And the selling price. Now, there are 2 different cost structures in the accounting syllabus. We have margin and markup, and you have to know the differences between both. Otherwise, you're going to screw this up. So let's just put it out here just so you have a good idea or good overview what each is all about. Both margins and markups are essentially profits, but they are profits based on different variables. A margin, for example, is based on selling price. So your selling price would be 100%, whereby your margin is a 50%. That brings your costs to 50%. So margin is always based on your selling price. Whereas if you look at markup of 50% will be based on costs. So that brings the selling price to 150%. So margin is based on selling price, markup is based on costs. You just have to keep that in mind. So, to find our revenue, we first would need to be able to look for cost of sales, right? We first have to figure out what is the cost of sales. So, to calculate cost of sales, I'm going to bring in the opening inventory plus purchases, right? No returns here. And we're going to minus closing inventory. So opening inventory was given to us right above, 6,000. Closing inventory was 6,004. Okay, that's 400 more. And we also have the purchases figure from our purchases ledger control, 69,900. So I'll bring all that into the cost of sales. So opening plus purchase minus closing. That's the formula, right? Opening, we didn't sell it last year. You're going to sell it this year. So it will add into this year's cost. Closing inventory, you did not sell it at the end of the year. So we take it out from this year's costs, right? According to the matching principle, as well as prudence. So overall, you're going to get a cost of sales of 69,500, right? So now I believe we can finally work out something related to sales. So our cost is 69,500. This is 100%. Our markup is 50%, and with that you're gonna come to the selling price of 150%. So using a bit of mathematics here and the power of your calculator, you should be able to calculate the figure for sales to be $104,250. Right, that should be your figure for sales. 104,250. So with that, we get our gross profit of $34,750. Now, this is part 1. You don't need to do this, I'm just doing it to show you. So that's part 1 of our income statement, to calculate the gross profit. So once you have the gross profit, we're going to move on with part 2. So part 2 is where I will add other income and less our expenses. So do we have any other income? Do we have any other income? I mean, you don't need the opening balances anymore, so that's I can chuck it aside. So we're going to focus on the bank payments as well as the additional information. Right, do we see any other income? Yeah, I see one, right? We have the discounts of 380. So we're gonna add that in. I know that's very easily overlooked. A lot of people would have overlooked that, I know. So let's bring in other income, right? Discounts received $380. That's our other income, the one and only for this question. Then I can move on with deducting the expenses. So for the expenses, I will have rent and insurance. Yes. Is there any adjustments for accruals and prepayment? No. Do we? Oh, yes, we do. There was an opening balance at the start of the year, which is an insurance prepaid. It was prepaid at the start of the year. That means the 300 does relate to 2024. So insurance will be 10,420, another one easily overlooked. Yeah, another one easily overlooked. So you have to remember there's an opening balance. We have to adjust for that. Insurance prepaid. General expenses. Any adjustments required? No. Alright, nothing for wages as well. So I'm just going to park those two there. General expenses and wages. Okay, now is there any other item that I missed out? Do I put drawings in? No, right? We don't put in drawings. Okay, nothing else here. Opening balances, no adjustments. Anything in the additional information? One more, right? Depreciation. Depreciation is an expense. So 20% on the straight line method. So 20% of 28,000, that's going to give you 5,600. So we have depreciation there. 5,600. So sum up all the expenses and how much are you getting? $27,150. So let's do the math. We take our gross profit, add in with the other income, minus the total of expenses. How much do you get? $7,980. That is our profit for the year, and there is our entire income statement. That's the whole income statement. Now that is part 2, where we calculate profit for the year, right? Add other income less expenses. There we go. That's part B of the question done. It was straightforward. The only thing you probably have to work out a little bit will be the revenue part. In fact, even if you do try to use the control account to calculate revenue, I don't think you're gonna get an answer. I don't think so, because we do not have the closing receivables. So how are you gonna get the answer if you don't even have the closing receivables? How are you gonna prepare the sales ledger control? It's impossible. So the only way you're gonna work it out is to make use of the cost structure, right? The 50% markup. Okay, so let's tackle on part C then, okay? Calculate Rexford's trade receivables at 31st December 2024 at the end of the year. You can open up a ledger, that's possible, but it's only 3 marks and they've not given us a lot of space here, so I will probably use a mathematical equation. So let's bring in the opening balance first. Opening balance of receivables. $21,750. Okay, so let's bring that in. $21,750. Now I'm going to add the total of credit sales to my receivables. So 104,250. So at the beginning of the year, they owe me about 21,000. I made a further sale of about 104,000 to them. And during the year, they paid me a total of 103,000, right? 103,200. So I'm gonna minus the payments off. So from there, we will get the closing receivables without even using the ledger. So your answer is 22,800. I mean, you can use the ledger. They're not going to penalize you if you do it. It's up to you. But since it's only 3 marks, I wouldn't waste a lot of time. Right, so I can move on to part D of the question, the last part. Rexford is considering employing a part-time bookkeeper. The bookkeeper would be paid $5,000 per annum. So advise Rexford whether or not he should employ a bookkeeper. Justify your answer by providing 2 points for and 2 points against employing a part-time bookkeeper. This question threw a lot of people off. I don't think anybody was expecting this question, in fact. But it's not too difficult as long as you have a basic understanding of what a bookkeeper does. Right, you should be able to get at least 3 out of 5 marks here. Okay, but you have to give them 2 points for and 2 points against. Very specific. So 2, 2 plus a conclusion. So let's start you off. Let's talk about 4. Why should we employ a part-time bookkeeper? If I employ a part-time bookkeeper, what will he or she be doing? Recording and summarizing transactions, right? Performing data entries into the ledgers. So when I have a part-time bookkeeper, my account figures are kept up to date, right? So I will know what is the total of rental I've incurred so far. I will know what's the total of electricity I've incurred so far. I know, right, how much money I have in cash in hand or in the bank. So with all these updated figures, it will facilitate decision making, or we can mention that it helps the owner to monitor business performance, right? You can talk about that. So with all the updated figures, we can see how well we are doing. Right, let's give you one more point. When I have updated account figures, what can I do? I can monitor any outstanding debts, right? So receivables and payables are kept up to date. I can monitor what is the outstanding debt. So this will be another form of credit control. Right, besides that, I can also monitor any outstanding payments to my suppliers. So in order for me to take advantage of my cash discounts. Yeah, so I'm going to give it to you in points. You can elaborate it however you want. But these are some of my points to go for employing a part-time bookkeeper. So with that, let's go against it. Why should we not employ a part-time bookkeeper? Well, first of all, you're going to be paying the bookkeeper, right? So that will increase expenses, okay? Increase our costs. Hence, reducing profits. Profits are going to fall drastically. Number 2, not only does it have an influence on your profits, it will also stress out the cash flow, right? Profits and cash flows are two different things. Profit will fall, but at the same time, your money, your liquidity is gonna be stressed out, right? Liquidity. And let's give you a third point. What else can you talk about, right? Why you should not employ a bookkeeper? They do help you, they keep the accounts up to date. It will help you with decision making. You can monitor outstanding balances. But why, right? Why are we against hiring a bookkeeper? So the bookkeeper does not prepare financial statements. This is your general understanding of accounting, right? Bookkeeper records and summarizes transactions, but they don't deal with anything related to the financial statements. So in the end, you will still have to get an accountant to prepare the financial statements. The bookkeeper can reduce some of your workload, but you will still need an accountant in the end. right? So that's our points against employing a part-time bookkeeper. And with that, we have completed the 2025 May June accounting paper 2. So I hope this has helped you in some way or another, right? I hope this series of videos is helpful to you. So if I did help you in any way, feel free to share my videos with a friend, right? Make sure to like, share, and subscribe, and I'll see you for possibly another discussion soon. I mean, let me know what type of videos you want to see. Maybe more commentary videos, or maybe videos on specific topics related to accounting or business, or even ACCA itself, right? Or, if you want me to do a Q&A session, I mean, I do have some requests for a Q&A. I mean, I'll leave that possibility open. No, I'm open to doing a Q&A anytime. Yeah, let me know, right? So I'll see you all